Welcome back to X and Yong. Today I will show you how to know whether or not the stock is profitable. This is one of the ways to do your due diligence and make comparison among several stocks in your watch list. This applies to those who want to pick and invest in individual stocks in their portfolio. As we mentioned earlier in the previous video, please do your own due diligence before investing your hard-earned money. Do not rely on others' opinions or news to invest. As a value investor, we are looking to invest in stocks that have growth potential for at least 10 years. Therefore, it is very important to have good understanding of the company business model and believe that it has future growth potential. Looking at the financial numbers is to give affirmation that the company has satisfactory past track record and to determine the intrinsic value of the company. The first step is to find the company annual report. All companies listed on the stock market must publish their annual report to the shareholders. Annual reports is intended to give information to the shareholders about the company's operations and financial performance for the past whole year.
We can go to internet to search for the annual report. For example, I want to search Google annual report. Then I just type it here. Google is owned by Alphabet, so just click on the first link for Alphabet Investor Relations. Then we will see the annual report for year 2019. You can also check on the most recent press release for Q1 year 2020.
Why we want to look at the company's past performance? If we intend to hold the stock for at least 10 years, we definitely want to invest in companies with strong finances, especially during an economic crisis. Only companies with strong finances will be able to sustain through the crisis, while the companies already facing financial issues will probably can't survive through the crisis. Recently, due to the global pandemic and the oil price collapse, a growing number of companies have filed for bankruptcy. For example, JCPenney, the department store in the USA, Hindon Trading, the oil trading company in Singapore, have filed for bankruptcy because they are making losses and unable to pay off their debts. If you learned something from this video, do click the like button for the YouTube algorithm and subscribe to our channel as we will continue to share more about personal finance and investing.
This is 2019 annual report for Google. Have a look at the table of content. Basically, the company will share about its business operation and financial information. Today we will go to its financial statement, starting from page 39. Look for the consolidated statement of income. We want to see how much the company made for the year. To be conservative, we should compare the numbers for at least 5 to 10 years back. Those are the past track record of the company. Disclaimer: past performance is not an indicator for future performance. We want to know the company's profitability, whether or not the company makes money and consistently making more money every year. The income statement shows the company revenue, expenses, and the profit. Here we can straight away compare for the past 3 years from year 2017 to 2019. As we can see, the financial year for Google is ended on 31st December. Take note that the numbers shows are in millions dollars. Revenue is the sales income that the company make for the year. Minus all the costs incurred, we will get to the net income. So Google revenue have been increasing for the past 3 years, so as the cost and the net income. From the investor point of view, we will look at their earnings per share, in short EPS. It is also called the net income per share. The formula is the net income divided by the total outstanding shares. EPS is the portion of profit allocated to each share. Of course, the higher the EPS, the better. It means the company generates more profit for each shareholder. There are two types of EPS, basic and diluted. To be more conservative, we will look at the diluted EPS, which take into account the convertible outstanding shares. Some companies give their employees the employee stock option scheme, which can be converted into company shares in the future. A simple example, imagine the pizza is the net income to be allocated to its shareholders. There are a total of 4 shareholders, so the pizza is divided by 4. This is the basic EPS. However, the company actually gives the options to one of its employees to claim the share after 2 years of working for the company. It means the pizza is supposed to be shared with the employee as well, not now but in the future. Hence, the pizza is now divided by 5. This is the diluted EPS. So, we will notice that the diluted EPS is smaller than the basic EPS because more people are sharing the net income. EPS is already calculated and stated in the income statement. For Google, we can see that its diluted EPS is increasing year by year from $18 to $43.70 to $49.16, which is a good sign, which means the company has track record of making money. As an investor, you want to find companies like this.
There are definitely many more numbers and ratios that we can compare in the annual report. From an investor point of view, we want to know whether or not the company is making money and how much is it for its shareholders. If the company is making a loss and has decreasing net income, it is actually a red flag that the companies may not be sustainable. During an economic crisis, strong companies will survive, while the weak will be wiped out. In conclusion, to know whether or not the stock is profitable, ensure the diluted earnings per share is always positive. A growing EPS is even better because it means the company is making more money year by year. Thank you for watching. Don't forget to smash the like button and subscribe to our channel. Stay tuned!